I've unlocked a big time secret. Do you want to know what it takes to get your loan approved every single time? Well, today, your boy Cody's got the goods. Hey there, clever investors. Cody Sperber back again with another killer training video. And we're talking about how to get your loan approved by the banks every single time, which it's not what it says up there, but it would be cool if it said every single time. That would have been great. But anyways, moving on. Sometimes banks, they can be pretty particular about how they lend. So it's important for you to know what they're looking for so you can increase your chances of getting funding that you need to be able to close your real estate deals. Now, there's a lot of tips to get through, so I'm just going to break this video up into two separate trainings. Today, I'm walking you through the first 3 steps. Now, remember, hit that bell to be able to turn on post notifications. That way you get notified every single time I drop a brand new training video, which is good for you and good for me, right? It's a win-win. Let's dive in. So, y'all know me as a clever investor. And a lot of my content has been about understanding how to do deals in real estate with no money down and no credit. Well, these creative strategies have never been geared towards understanding how to build relationships with traditional lending institutions. So today, we're going to flip it on its head, and we're going to talk about how to actually do business with the banks. Now, most banks, they follow a certain model, or they have certain standards when it comes to lending. Now, I've done a ton of deals, so I've had plenty of experiences dealing with banks. But based on my experience, there are 5 steps to getting your loan approved. Step number 1 is to pull your credit and work on it. Step number 2 is to build a relationship with the banks. Step number 3 is work on your debt to income ratio. Step number 4 is to understand mortgages and which terms work best for you. And step number 5 is to be prepared to have skin in the game. Now, like I said before, in this video, we're going to be focusing on the first 3 steps. But before we dive in, I think it's really important to note that I'm not an underwriting expert. I'm not a mortgage broker. I don't have a mortgage banking license, any of that stuff. All right, these are just some time-tested steps and things that I've learned along the way that have helped me with my business and helped me get the lending that I desire. All right, let's dive in. Let's talk about credit. All right, most banks will use your FICO score to determine your credit worthiness. You have 3 FICO credit scores, and they're pulled from 3 different credit bureaus. They're Equifax, TransUnion, and Experian. Now, it's super important for you to know where you stand with all 3 credit bureaus because most lenders, they're going to want you to have a minimum FICO score of 580 to be able to qualify for, government-backed loans like FHA loans, and a minimum of 640 to be able to qualify for conventional loans. Now, there's some aggressive banks out there that will do deals with lower credit scores, but these usually require having a significant down payment or other types of collateral. So to get the best position possible, you're going to want to reach for at least a 640 FICO score. Now, you can pull your credit report for free from annualcreditreport.com, and I'm going to put a link down in the description down below so you can do this because this is a free service where you can pull your credit report once per year, so take advantage of it. And you're going to want to pull this information so you can understand everything that's on your credit report so you can either fix it or you can make improvements. If your credit score is below some of these standards, this is what I recommend you do to be able to increase your credit score. First and foremost, number 1, make sure you have accurate information showing up in your credit report. This is really important because the information on your credit report is either hurting you or it's helping you, right? It's that simple. And if it's not accurate and it's hurting you, you're going to want to fix it or dispute the information with the credit bureaus. So just check to make sure that all your accounts are actually your accounts and make sure they're showing the most up-to-date information. Number 2, if you have collections, work really hard to get rid of them. Now, you can do this in different ways, but make sure that you do your further research on the best way to get the collections removed. Now, I'm just going to tell you a quick story. I had a rental property a long time ago, and a few years ago, it went vacant. And I had to go in there and turn the power back on and fix the rental property up to get re-rented. And at some point, my assistant did not pay our electricity bill. Well, I pulled my credit report a while ago and it was on there as a collection for $120. And so I hurried up, I called the credit bureaus, I got the collection paid, I got a letter from the collection company, and then I sent it off to my credit bureaus, and I eventually got it taken off my credit, which boosted my credit score. All right, so the best thing to do is pay your collections. Number 3, make sure you're not missing any payments on any revolving accounts. Payment history is the number one factor that credit bureaus use to determine your credit score. All right. Number 4, make payments on time and be consistent. Pay down your balances. I don't recommend paying them all the way off, but pay down your balances. All right. The credit bureaus like to see your balances going up and down, like you're revolving the credit line. So I'm going to talk about paying down your balances a little later in this video, but the more you pay down your debts, the better you're going to look to the banks. It's called credit utilization, and it's a major piece of your credit score. So make sure you're not maxing out your balances and you're not fully paying them off. And you're going to want to keep a whole bunch of open credit lines, as many as you can, because that actually looks good. It's kind of backwards thinking, but when I went to get a loan one time, they actually said, hey, you don't have any personal debt. You have a couple credit cards. I had some business cards and I had one personal credit card, and they're all paid off. And they're like, hey, we need you to open up another credit card and charge at least $25 on the credit card so we can get your credit score to go up a little bit more so we can qualify you for a better rate, which is backwards thinking, but that's just the way this thing rolls. Number 5 is think about opening up a secured credit card to build up positive credit history. If you don't have credit history, the easiest way to get a positive history is to open up a secured card and just build up the history. Every single month, it's going to report to the credit bureaus, and the longer you pay and you pay on time, the higher your credit score is going to climb. Now, pulling your credit report is not going to give you your credit score. All right, credit reports and credit scores are two separate things. So if you want to see your credit score, sign up for a free credit score service such as Credit Karma or Credit Sesame. I'll also drop those links in the description down below. All right, it's important to note that these services, they're going to give you a quick snapshot of your credit score. They're not always super accurate, but they're going to get you pretty dang close to what your actual score is. So make sure you utilize those free services before you walk into a bank. That's the key. All right, now that we've done that, my next step would be to go and start building relationships with the banks. All right, you have to go in to the bank and start to build a relationship with them. In reality, no one has been able to just waltz into a bank and you just roll up and you say, my name is Cody, I want to borrow a bunch of money, and just have them, slide over a bunch of money to you. It's just not the way it works. The loan process, it takes time, and it's a relationship thing. Research the banks that have the best lending programs that you're interested in. Not all banks offer the same programs, especially when it comes to investor loans. So make sure that you go online, you do your research, you figure out what local banks, what local credit unions are in your area that are actually working with investors. And quite frankly, get some investor referrals, all right? That way you can start to do your research. And then I would just make a list. And once you have a targeted list of banks that you plan to go to, what I would do is I would call up and try to get a meeting with their commercial bankers or their lending managers. These are the people that you want to build a relationship with. These are the people that you have to sell your story to, so that way they understand who you are, so they can go to the underwriters and sell your story to them. And then before you know it, everybody's your ally. Everybody's on, Team Cody Sperber trying to help you buy more investment properties using and leveraging their money. The better the relationship, the higher chances you're going to have at building wealth and building up your rental portfolio. Now, having bankers as your friends, obviously, it's a great thing. I've never known a banker to not be helpful. All right? At the end of the day, they want to help you get a loan. They're not going to make it easy, but they want you to borrow their money. This makes them look good, and bankers have annual goals that they have to hit. So get to know these people and help them help you. Now, outside of having an acceptable credit score and a friend at the bank, you need to understand something called your DTI. Now, what does DTI stand for? DTI stands for debt to income ratio. This is the major ratio that's going to help the bank determine if you have the financial capacity to pay for the loan. Now, debt to income is calculated by taking your monthly debt payments and dividing it by your monthly gross income. Now, let's just take a quick look at an example so you can understand how to calculate this for yourself. Now, let's just assume that you're going to be applying for a loan at a bank, and after looking at your finances and your credit score and building a relationship with the banker, you determine that your monthly debt payments are roughly $1,000 a month. Let's just say that you make $60K per year or $5,000 gross per month. This means that your debt to income ratio would be 20%. That's $1,000 in debt payments divided by $5,000 in income, which equals 20%, which is not bad. Now, a good rule of thumb is to follow the rule of 36. Pay attention, all right, and take notes on this. The rule of 36. The rule of 36 states that in order for you to be deemed less risky, all right, you're going to want to keep your DTI at 36% or lower. Now, obviously, the lower your DTI ratio, the better you're going to look to the underwriters. Lending, it's all about risk, and having a low DTI shows the banks that you have more available funds monthly to be able to handle any new debt payments. So measuring your DTI and figuring out if you fall within these guidelines is really, really important. So if your DTI is too high, you're going to want to either lower your debt or increase your income. Everybody has different circumstances, so make sure you evaluate what works best for you, because this whole entire part of, being able to pull this off is really, really important. Now, I know we covered a lot on today's training video, so let's just recap real fast what we learned here today. Step number 1 is to pull your credit and work on it. No bank's gonna lend you money if you have bad credit. Step number 2 is to build relationships at the bank. Having a good relationship with the bankers is your best bet at getting a loan approved. And step number 3 is know and understand your debt to income ratio. Calculate this, know where you stand, know where you need to make adjustments or improvements, and remember, keep this below 36%. All right, that's all I have for you for today's training video. What do you guys think? Now, in part 2, I'm going to be going over in detail my last 2 steps, which are understanding mortgages and being prepared to have skin in the game. So for this one, let me know what you guys thought about part 1. All right, down in the comment section down below, give me your biggest takeaway. Don't be just a bystander. Don't be somebody that just watches this video. I put a lot of work into these training videos, so do me a favor. Help me hack the YouTube algorithm by dropping me a comment down below and letting me know your thoughts on this one. And also, don't forget to smash that like button if you got something from this. Turn on post notifications and check out the pinned comment down below. That's going to show you some more free training. This is just the tip of the iceberg. If you want to go deeper in how to build wealth in real estate, if you want to learn how to be a transactional real estate investor and make quick cash, the link down below in the pinned comment section is your starting place. This is my 30-day deal challenge where I'm going to walk you through how I got started in this real estate business and I made my first $1 million. And I'm going to show you when you click that link how you can get your hands on 3 of my top selling courses absolutely free. All right, take me up on my challenge and get started today. All right, that's all I have for you. Thank you guys very much. I'm Cody Sperber, the Clever Investor. Sign off for now. Until next time, take care, comb your hair, Sperber out.